What's up and welcome to Smart Money, where our mission is to give our viewers the motivation to make more money and the skills to keep it. In today's video, we're going to talk about sales tax. I'm going to tell you what it is, what makes it unique to the US, different variations of sales tax, and ultimately, what allows Khloe Kardashian to sell you overpriced water bottles. So be sure to watch this video to the end for that explanation. If you could do me a favor and like this video for the algorithm so YouTube knows to promote it to other viewers. And with no further ado, let's get to the video. The only two certainties in life are death and taxes. Depending on your level of wealth and connection, you may be able to circumvent certain taxes. The United States has 12 specific taxes that ultimately break down into 3 different categories. Taxes on what you earn, taxes on what you buy, and taxes on what you own. What is a sales tax? Sales tax falls under the category of tax on what you buy. A sales tax is a government-imposed transaction tax levied on the selling of goods and services. A traditional sales tax is assessed at the point of sale, collected by the manufacturer, and distributed to the government. A company is liable for sales tax in a given jurisdiction if it has a nexus there, which may be a physical presence, an employee, an affiliate, or some other kind of presence, depending on the laws of that jurisdiction. Sales tax are types of consumption taxes that are imposed on retail sales of goods and services. If you live in the United States, you've always seen sales tax written at the bottom of the receipts. Sales tax is a kind of antiquated means of taxation. Of the 195 countries in the world, roughly 10% still use sales tax. The United States is one of the few developed countries that still depend on a conventional retail sales tax as a major source of state and local revenue. With the exception of Alaska, Delaware, Montana, New Hampshire, and Oregon, all states and localities in the United States collect statewide sales tax, as do localities in 38 states. What is sales tax used for? Traditional or retail sales tax are only paid by a final customer on a product or service. Since the majority of products in modern economies move through a variety of processing stages, which are often managed by various agencies, a considerable amount of paperwork is required to show who is actually responsible for paying sales tax. For example, a hypothetical plastic manufacturer sells plastic casings to Samsung that the company will use to produce a cell phone. To avoid paying sales tax, Samsung must receive a government resale certificate stating that it is not the end customer. Samsung then sells its products to Verizon, which must receive a resale certificate as well. Finally, Verizon sells the new Galaxy 21 to Best Buy, which charges the consumer sales tax in addition to the price of the phone. Different jurisdictions levy different sales taxes, which often overlap, such as when states, counties, and municipalities levy their own sales taxes. Usage taxes, which apply to residents who have bought goods from outside the jurisdiction, are closely linked to sales taxes. These are usually set at the same rate as income taxes, but they are difficult to administer, so they are rarely applicable to large transactions of physical goods in practice. For example, a Maryland resident purchasing a car in Virginia would need to pay the local sales tax just as if she had purchased it at home. Retail sales taxes are a major source of income for state and local governments in the United States. Sales tax rates can have a big influence on consumer and business decisions. Sales tax dodging is most likely in places where there is a large discrepancy between jurisdictions. According to research, consumers can and do leave high tax areas to make large transactions in low tax areas, such as moving from cities to suburbs. For example, I live in the Washington, D.C. area where sales tax is 6%. When purchasing large ticket items like televisions, I can and have driven to Delaware, where there is no sales tax, to make my purchase. It might seem like a lot of work to drive 90 minutes from Washington, D.C. to Delaware to buy a TV. However, the sales tax on a $3,300 75-inch OLED television is $198 where I live, meaning that I can save $198 by driving 3 hours round trip to make the purchase. People who live in areas with large tax discrepancies do this to save money every day. Similarly, companies can choose to locate just outside of the boundaries of high-tax jurisdictions. In New England, for example, despite the fact that I-91 runs up the Vermont side of the Connecticut River, several more retail establishments tend to locate on the New Hampshire side, where there is no sales tax. By the way, if this video is giving you value, write sales tax dodging in the comment section. I'll do my best to reply to every comment I get. What are sales tax bases? Sales tax rates aren't the only thing to consider. The tax base, what is and isn't taxable, can have a direct impact on the productivity and efficiency with which different sales tax jurisdictions raise revenue. Sales taxes, according to tax experts, should be levied on the final retail sales of products and services, but not on intermittent business-to-business transactions in the supply chain. Taxing business-to-business transactions causes tax pyramiding, an economically negative phenomenon in which the tax burden accumulates throughout the supply chain, as in the case of gross receipt taxes. Sales tax nexus. The way a government defines a sales tax nexus determines if the company owes sales taxes to that government. A nexus is commonly characterized as a physical presence, but this presence is not limited to just having an office or a warehouse. Having an employee in a state may also be considered a nexus, as can having an associate, such as a partner website, that directs traffic to your business's page in return for a cut of the profits. This situation exemplifies the tension that exists between e-commerce and sales taxes. New York, for example, has enacted Amazon rules, forcing internet retailers such as Amazon.com Incorporated to pay sales tax despite their lack of physical presence in the state. Variations of sales tax. Excise tax. In general, sales taxes are calculated as a percentage of price of the product sold. For example, if a state has 4% sales tax, a county has 2% sales tax, and a city has 1.5% tax, residents of that city pay 7.5% tax in total. However, some products, such as food, are often excluded or are exempt below a certain level, such as clothing purchases of less than $200. At the same time, certain goods are subject to additional taxes, such as excise taxes. Sin taxes are a type of excise tax, such as the $1.50 municipal excise tax charged by New York City per pack of 20 cigarettes, in addition to the $4.35 state excise tax. Value-added tax. The United States is one of the few industrialized countries that still use traditional sales taxes. It is not the federal government that charges sales taxes, though. With very few exceptions, sales tax is charged by the states in the United States. Value-added tax, VAT policies, have been implemented in 140 countries, over 70% of the world. These countries charge a percentage of the value added at each stage of a product's development. In the previous cell phone example, the plastic manufacturer would pay a percentage of the difference between what they charge for plastic and what they pay for raw material. Similarly, Best Buy would pay the same percentage of the difference between what they charge for phones and what they pay Verizon for them. To put it another way, this is a tax on the company's profit margins, not just the end user. Sales tax versus value-added tax. A value-added tax, VAT, is a sales tax imposed on the value added at each point of the manufacture of a good or service. Any company in the supply chain earns a tax credit for the VAT they have already paid. The final buyer does not, because it's a charge on consumption. The primary goal of implementing a value-added tax is to remove tax on tax, or double taxation, which rolls down from the manufacturing to the consumer level. For example, I understand Khloe Kardashian recently started selling a BPA-free water bottle. A water bottle manufacturer might purchase raw materials for $10, which includes a 10% tax. This means he pays $1 in tax for materials worth $9. During the production process, he adds $5 to the original products for a total amount of $15. The finished good would be subject to a 10% tax totaling $1.50. In a VAT scheme, this extra tax can be deducted from the previous tax he charged, lowering his effective tax rate from $1.50 minus the $1 tax he paid for raw materials to just 50 cents. With me so far? Let me know if you're able to keep pace with the explanation in the comments section. Khloe Kardashian's wholesaler pays $15 for the water bottle and sells it to the manufacturer for $17.50, a $2.50 markup. The 10% tax on the gross value of the water bottle will be $1.75, which he will offset against the 10% tax on the original cost price from the seller. As a result, the wholesaler's effective tax rate would be $1.75 minus the $1.50 in value manufacturer added, netting the additional tax of 25 cents. This means that the water bottle now has a value of $19. Let's assume that Chloe's profit margin is $1.50 per bottle. Remember that the VAT tax in this example is 10%, meaning that the total tax will be levied from the manufacturer to the supplier will be $1 for raw materials, 50 cents for production, 25 cents for wholesale, and 15 cents for tax on Chloe's profits to equal a total tax of $1.90 on this water bottle. Are you looking for a way to effortlessly keep track of your tax write-offs? Use Keeper Tax and never worry about forgetting to claim a write-off again. If you buy something that might be a write-off, Keeper Tax will text you. All you have to do is reply. Users on average save over $2,076 per year. Use my link in the description and get 2 weeks to try Keeper Tax for free. Check out these videos on your screen on how to improve your finances. If you like this video, hit the like button so the YouTube algorithm promotes our video to other people. Be sure to subscribe and share the video with your friends. Check the links in the description for offer information. Thanks for watching, and I'll see you in the next video.